For many years, the term financial literacy implied people just need information to manage their finances productively. However, over time, it has become clear that increasing financial security is not just about financial literacy and knowledge. Instead, it is very important to have financial capability, which is the capacity, based on knowledge, skills, and access, to manage financial resources effectively. This video will review the details of financial capability and its importance to your clients. There are four key areas of financial capability. The first area we will consider is knowledge. By knowledge, we mean to describe what a person knows about positive money management. For example, for Andrea to have strong financial management, she needs to know that she has a credit report and score. She also needs to know that she pays interest on credit card balances and that she can be charged overdraft fees if she overspends from her checking account. Without this knowledge, Andrea will have difficulty in having strong personal financial management. The second area is called action, or what someone does with their financial knowledge. Action refers to having the skills and ability to apply financial knowledge. However, just because a person knows what to do doesn't mean that they will actually do it. Here are some examples. If Jamie doesn't balance his checkbook, it could lead to costly fees or the financial institution closing the account. If he doesn't compare interest rates on car loans or credit cards, it can lead to high interest rate borrowing. Or he may know to spend less than he earns, but if he doesn't track his spending, he won't know how he is balancing the two. Next, we will discuss access, which is the availability and use of appropriate financial products or services. More specifically, access refers to financial inclusion and being able to use low-cost financial services. Access also applies to the opportunity to use financial knowledge and skills. A key question is, does someone have the opportunity to earn income, access a banking account, or apply for a small business loan? For example, Taylor may be entrepreneurial and prepared to start a business, but may not be able to apply or receive a small business loan. She may have great money management knowledge and abilities, but does not have access to affordable financial products such as a checking account due to limitations in her geographical area, past credit history, or lack of internet access. Or she may also have limited access to jobs paying a living wage. Influences, or factors that contribute to a person's beliefs, attitudes, and behaviors about finances, is the last area of financial capability. Influences include both internal and external forces that can support or hinder financial capability. An individual needs to have confidence to apply their financial knowledge. For example, if Andre has had a bad experience with credit cards or checking accounts, he may never want to use that product again. Also, if he has the habit of online shopping when he is stressed or bored, he may make spending decisions that don't fit his priorities. All areas of the financial capability framework, including financial knowledge, action, access, and influences, are critical to a person's success in managing their money. Yet, helping professionals should also be aware of their client's context. Your client's context can also impact their capacity to manage financial resources effectively. An example of a client's individual context could be their personality. Some individuals may be detail-oriented, while others may prefer to consider big-picture issues in their lives. Another part of someone's context is their family. For example, someone with family responsibilities may behave differently than a single person due to those responsibilities. Next, an individual's community, including friends and network, can influence their financial capability. For example, George may have a community that includes people with organizational power who can write letters of recommendation for jobs he is interested in pursuing, while Luca may not have that opportunity. Lastly, societal context can influence a person's financial capability. For example, someone may struggle to find affordable housing in their area due to limited options resulting from zoning policy that doesn't allow for development of multifamily units. To understand your client's financial situation, it is important to consider their financial capability as well as their context. As a next step, consider this question: how can you apply the financial capability framework to your work?